Good morning and thank you for joining us for the 2023 pre-planning market message. While you operate today in a market rich with opportunity, my oversight head is filled with customary levels of trepidation. In a market where the balance may be leaning in the underwriter's favour for the first time in a long time, I will seek to highlight the areas that I believe require increased focus in the 2024 planning season. I do this to help, not to hinder the market's progress. And I do anticipate 2024 to be another year of strong growth for the Lloyd's market. But the prevailing underwriting conditions remain complex and ill-disposed to either a laissez-faire, risk-on approach from you or sweeping generalizations and oversight from us. Our sphere of focus extends beyond the near-term planning horizon to highlight the risks we think you should manage and warn of those we think you can only mitigate. We feel confident in the market's ability to navigate a uniquely challenging backdrop. However, the current environment warrants a moment of reflection. We have a conflict entering its 16th month on the continent of Europe. We have geopolitical tensions among global economic powerhouses. We have economic uncertainty in the largest economies. We have inflation still at 20-year highs in the major markets in which we underwrite. We've experienced nat cat losses above expected levels in 6 out of the last 7 years. We face the additional challenge of climate change that is likely to exacerbate these losses. We have a historically challenging reinsurance market, and if that all wasn't enough, 2024 is a major election year in the countries that generate 70% of our GWP, with significant policy implications on the ballot. And yet, I detect no panic in the air. But we have not reached an oasis of calm. Rather, we are operating in a world that has settled on a plateau of manageable chaos. We take confidence from the fact that the market adapted to deal with the challenges posed by the last 10 years. And now our principle-based oversight regime should help us adapt more quickly in the future. We'd like to cover 4 areas today. Firstly, a stock take on the state of the market. Then we're going to share our forward-looking underwriting views and areas of focus. We'd like to outline our approach to 2024 planning for underwriting and capital. And before we close, we're going to give an update on our thinking around claims in the Lloyd's market. The focus areas are not exhaustive, but rather have most universal relevance and materiality from an oversight perspective. I will talk for a bit longer than usual, but fear not, this is a once-off rather than a trend, as this time next year our incoming Chief Underwriting Officer, Rachel Turk, will be doing most of the talking. I'll then hand over to Emma Stewart, Lloyd's Chief Actuary, for the Finance and Capital section. We'll keep our comments to around 30 minutes before opening up to Q&A. So, with recent market level results relatively strong, and conditions more favourable to risk-bearing capital, I thought it was important to give deeper context to our thinking for the upcoming planning period. 2022 looks in decent shape and continues the post-COVID trends from 2021. The market produced an improved GAAP net combined ratio of 91.9% in 2022. Growth of 19% was pretty much in line with RARC and inflation assumptions, with a modest expansion in exposure of around 4%. Further improvement to the attritional loss ratio to 48.4% reflects continued underwriting and pricing discipline. This result sets the foundation for a strong 2023. And due to the shape of the Lloyd's portfolio, it has been a quiet first quarter for CAT, both natural and man-made. There have been no drastic reversals in underwriting conditions compared to what was expected at the turn of the year, with positive and negative trends accelerating in property DNF and FinPro respectively. So planned GWP is forecast to grow by 15%. On the whole, we're encouraged by the continued market discipline as judged through the lens of changes requested to plans. Exposure is slightly down compared to original plan, driven predominantly by increased risk-adjusted rate change in property. At a portfolio level, planned RARC has risen from 3.6% to 5.1%. And growth is coming from property D&F and property treaty, with a contraction in D&O and cyber. So in our view, we see sustainable returns for the proximate risks in property, notwithstanding many challenges ahead, if syndicates retain control of their capacity deployment and distribution. However, the casualty and FinPro lines require careful consideration of the longer-term implications of the prevailing conditions. So in summary, we've made an underwriting profit in the last 2 years, but we're some distance away from any justification for celebration. I'd like to take a minute to talk about the changing shape of our portfolio. In the past 10 years, the risk profile of the Lloyd's portfolio has changed significantly. The charts on the left-hand side show that long-tail business now accounts for roughly 40% of the portfolio, compared to only 29% 10 years ago. The charts on the right demonstrate that while property D&F remains the largest of the Lloyd's L10 classes, all casualty classes aggregated now comprise a larger overall proportion of the portfolio than property. The chart in the top left of this slide demonstrates that from a distribution perspective, geographic growth has predominantly come from North America. Our footprint continues to be reflective of countries that have a wholesale model to complement domestic insurance carriers. And looking at the distribution, the charts on the right-hand side show that growth has been driven by binding authority and open market placements, while reinsurance has lagged significantly behind. From an exposure perspective, aggregations have changed in line with the shape of our portfolio and changing exposures driven by socio-demographic shifts. While we are yet to see the impact flow through to actual claims experience, the chart in the bottom left shows that US wildfire, severe convective storms, and flood are now approaching the same level of materiality as the smallest of our LCM5 perils. So it's critical that we ensure that our focus and oversight evolves commensurate with the changing shape of the portfolio and the evolving risk landscape. And as we operate from this plateau of elevated risk, it is important that we don't allow the feeling of normalcy to drive complacency. We must remain vigilant and ensure that we are well positioned to manage the downside of key external pressures, as well as take advantage of any opportunities presented. There are 6 key stimuli which we believe should be driving your strategic thinking this year. So let me explain how we believe these will apply to specific focus areas heading into planning. First up is geopolitical risk. The geopolitical landscape continues to be characterized by regional conflicts and growing instability in economically significant parts of the world. And trade disputes and economic sanctions will have profound impact on supply chains and have second and third order impacts for underwriters. We're currently reviewing the results of our 3 escalating scenarios centered around the Taiwan Straits. And the extrapolation from Ukraine is not that difficult to draw. This should give syndicates pause for thought for the likely price and capital implications on related portfolios. Let me give you an example of how we're thinking about political risk, terrorism, and strikes, riots, and civil commotion as a result. So as net exposures increase, it is imperative that you're able to demonstrate credible ROARC and price adequacy metrics. In our view, there has been minimal improvement in rate adequacy and insufficient response on the primary side to tightening of reinsurance terms and conditions. Further, we've been surprised by underwriters' lack of response to the coverage and terms offered on new and existing facilities. Chasing top-line growth and pursuing customer acquisition strategies to meet expense challenges is unacceptable in these classes, as is the pursuit of diversification as a primary strategic driver. So our engagement with you in this class will not be purely performance-focused. This will be an exposure and expertise review. Moving to macroeconomic pressures, there remains a need to be cognizant of the impacts that interest rates, inflation, and recessionary pressures have on your portfolio. The current interest rate environment does not influence our view on cash flow underwriting. We have no appetite for such strategies. If anything, under current conditions, we would expect syndicates to want to build in an increased buffer in plans to ensure they do not stray above a 95% net combined ratio. Inflation must remain front of mind when considering pricing, reserving, and capital, particularly for longer tail classes. and Emma will cover this and the importance of managing back books as we move into the next phase of inflation more fully in the capital section. Finally, the possibility of recession must be on all of your horizons. The past 18 months have been characterized by an unstable economic outlook, and some of these problems did come home to roost in 2023. The well-publicized bailouts of Silicon Valley Bank, First Republic Bank, and Credit Suisse highlight just how quickly contagion can manifest and how difficult it is to combat actual or perceived fragility. So what does this mean for key focus areas beyond your general portfolio? We've been focusing our attention on D&O to ensure that price adequacy does not drop off before loss development can be properly evidenced. Let me demonstrate what I mean. This chart shows the loss ratio deterioration for D&O after 1 year, 4 years, and up to fiscal year end 2021. As you can see, the 2014, 2015, and 2016 years of account show significant deterioration from year 1 to 4, and then again through to the end of 21. So we believe the better view is to be cognizant of these trends in current pricing. At this time last year, we majored on the theme that the management, control, and performance of delegated authority business required improvement. The chart on the screen shows that when we compare the performance of delegated business to open market, we see that in softening conditions, performances tend to deteriorate more quickly. And likewise, as the market hardens, remediation efforts take longer to effect. And this was clearly evidenced in our property binder portfolio deep dive that we completed earlier this year. So delegation cannot come at the expense of underwriting excellence and appropriate governance. So we expect to see an alignment of interest and full transparency through the value chain. Our market is already well established at overseeing its DA business from a compliance and regulatory perspective. We want to make sure that performance management is given the same level of rigor. Full details of the additional data requirements for 2024 are now in your pre-planning letters. Next up are catastrophe loss picks. This remains a key focus area for us. The chart now on the screen shows the historical miss between actual cat losses and plans. We've tended to see actual cat losses exceeding plan year after year. We've done a lot of work with you to validate that cat loss ratios are appropriate, but this work is not complete. When we spoke in March, we said that we expected certain features of recent reinsurance renewals, such as the lack of sideways cover, increased attachment points, and tighter coverage, to actually increase the volatility of cat-exposed portfolios. This means it's more important than ever that we can have confidence in your understanding of the gross risk. So with that in mind, we'll continue to scrutinize the entire catastrophe risk distribution, including modeled average annual losses, and the SPF catastrophe loss ratios at 1 in 10, 1 in 30, and 1 in 200 year metrics. We need to make sure that your cat loss picks are appropriate for the current risk environment. And just to be clear, the improving rate environment does not alleviate the need to understand your aggregations and manage exposure properly. A rising tide will not float boats that are holed below the waterline. Moving on to reinsurance. Given the relatively high ceding percentage to third-party reinsurers from Lloyd's at about 25%, we are sensitive to the current market volatility. This is probably particularly the case for management of aggregations and systemic risk. There's still a heightened level of execution risk associated with the outwards reinsurance purchasing. So if reinsurance coverage is not back-to-back with inwards business, we expect that your net line sizes and aggregations will reflect this gap in cover, and you will price and capitalize accordingly. We'll be particularly focused on this misalignment where syndicates are writing on facilities with expansive wordings if the syndicate cannot demonstrate the aggregation of risk properly. Now, I think the market did a very good job on this in last year's planning round, so basically we're asking for more of the same. I'm going to finish with our perennial favorite of cyber. Now, the recent rollout of the Lloyd's Bulletin has not been elegant. However, I want to reiterate that we see the segregation of systemic risk from the core cover as critical to the maturing of this class. While we attempted to work through the grey areas in the interest of smooth adoption, I think we've now reached the point that a more definitive approach is required. So we have set all of this out in our attestation letters that the market will have received yesterday, but maybe let me make a few things clear. If you broaden the coverage to include risks that are outside the letter of the bulletin in the core product, this de facto will increase the exposure you underwrite, and you will require more capital as a result. So any exposure to state-backed cyber attacks or significant impairment within the core product will be assumed to equal the full policy limit unless syndicates can demonstrate this is not the case, for example, by sublimit. This exposure will result in an increase to the materiality thresholds for syndicates under the non-nat cat dimension of Rio. And any failure to meet expectations may result in a downgrade of the syndicate or act as a barrier to achieving outperforming status. This does come with the full resulting consequences on the 2025 SBF and beyond, including the potential use of capital loadings as deemed necessary. In exceptional circumstances, immediate action may be taken with negative consequences for the 2024 SBF process. So in summary, for those who are showing determination to write the segregated coverages separately in the spirit of the bulletin, you have our full-throated support, and we will endeavour to make this as straightforward and efficient for you as possible. But for those who want to continue to offer the broadest coverage within the core product, when the adoption phase settles down, that will necessarily be outside of the Lloyd's market. Now, I'm not going to spend an inordinate amount of time on planning and on the approach to planning today, as the detail has been spelled out clearly in the pre-planning letters. But what I do want to emphasize is that we'll continue to iterate the approach that our principle-based oversight allows. The three goals that will be motivating us this year will be increasing the differentiation between the 5 categorizations of oversight, being clear and articulating in detail what we will and will not be reviewing, and thirdly, being true to the words we use in categorizations. So de minimis really will mean no trifling matters. However, it is critical that we as a market manage the risk and opportunities arising from the key macro trends and the areas we have designated for increased focus. But by better defining key focus areas and levels of materiality for challenge and doing it earlier with more specificity, we will look to ensure a better planning experience for all. So how will the differentiation work this year? For the outperforming syndicates, you will experience a truly de minimis approach. We expect that all material themes will have been discussed and agreed through SPD engagement, and retention of your outperforming status will be achieved through your ability to maintain a track record of sustainable profitability, an ability to hit plan, and of course demonstrating the competence to meet expectations across all of the Rio dimensions. For good syndicates, we'll be focusing our review on the area of your business that is driving the overall rating and the potential impact of such on underwriting. Moderate syndicates can expect a full and detailed plan review. It is incumbent on you to give us confidence in your key material assumptions, including all loss ratios. For syndicates classified as underperforming, we expect that you will be operating strictly within the confines of your pre-agreed remediation plans and ensuring clear willingness to lose appetites around forward-looking volatility. For all syndicates, the need to deal with our key macro trends is critical, and for all, it is outcomes, not promises, that drive ratings. Performance remains our #1 priority, and that will be reflected in our judgments throughout planning. Now let me now pass over to Emma, who will cover all of the critical capital reserving and other finance themes for this year's planning. And I'll pop back at the end to sum up. Emma.
Whilst market conditions put us in a good position for strong performance and results, it remains as important as ever that planned exposures are adequately capitalised for, and the 2024 capital setting process will reflect that. It's worth bearing in mind that there will always be cases where the justification we need to get comfortable with the capital submission is greater than that for agreeing the plan submission, and that can happen for any syndicate undergoing any level of capital review. Despite the profitable market conditions, I expect that there will continue to be some sensitivity around the level of capital a syndicate requires. In particular, with growth in premium and net exposure, capital requirements will increase, and there is a lack of new capital coming into the market to provide increased capacity. Additionally, the landscape continues to be unpredictable, and we face new, unprecedented combinations of challenges which capital models need to reflect. Whilst these macro events have, to a degree, settled, they are not behind us, with many wide-reaching uncertainties still persisting and an evolving nature which creates a different challenge for capital modelling. However, it does enable our risk-based oversight to focus more on high-risk syndicates rather than taking a broad-brush approach to all syndicates in light of the systemic risks. This means that we will scale down focus areas that we request market-wide information on, and it will also enable fast-track syndicates to feel more differentiation compared to last year. Whilst we won't be asking for as much information directly in capital submissions on macro issues, as always, we expect syndicates to be considering if models are appropriately reflecting prevailing conditions and responding accordingly. Geopolitical uncertainties will directly impact the volatility of some classes, and whilst we learnt lessons from Ukraine, these are not likely to be the same classes impacted by that conflict. Syndicates need to rely on more than just history and need to think about dependencies in the model. For example, you may have considered where financial market losses drive insurance losses, but not if potential insurance losses from, for example, geopolitical tensions drive market volatility. Interest rates are higher than in recent history, and there is arguably more volatility around them. We're used to dealing with one-way interest rate volatility where rates could basically only go up, and now there is a two-way risk to be thinking more about the impacts of. Also, it is not obvious if UK, EU and US interest rates will move in alignment, so you need to think about your exposures and which interest rates they will be specifically impacted by. Furthermore, we have seen disruption in some parts of the international banking sector, so syndicates should be thinking about concentration of banking exposure by geography and by type of bank. The step increase in inflation seen in 2022 may be old news, but inflation is now entering a second and arguably more complex phase. Phase 1 was the emergence and shock of the step change to the heightened inflationary environment, where the market broadly responded well to the need to make allowances for this in pricing, reserving and capital. However, Phase 2, where the impact of inflation is emerging in claims experience and data and at a differing pace by line of business, represents murkier waters for claims and reserving professionals in particular to navigate. Last year, responsibility mainly fell to reserving actuaries, making explicit uplifts on top of no allowance being made in claims triangles. Looking back, maybe that was the easy bit, as now claims teams must work closely with the actuaries to determine what is and isn't in the data, and therefore what additional allowance needs to be made for inflation for claims for losses that have been incurred but not enough reported, as well as pure IBNR. Syndicates need to be alert to the fact that what could appear as benign experience in actual versus expected analysis could be a result of claims inflation not emerging in the data at the pace assumed. And therefore, whilst difficult, claims analytics and close collaboration are very important in assessing the required inflationary uplifts and making sure that allowances are not wiped out prematurely. It's then critical that this analysis is fed back into the areas of planning and capital to make sure that price and capital adequacy is genuinely appropriate and reflects an accurate and up-to-date view of claims inflation. To support the market with the continued challenges on inflation, over the next few months we'll be sharing guidance on good practice for boards to consider. Firstly, in respect of risk management practices, and then separately regarding claims management, where we'll be working with the market to establish what is best in class and play this back to market members. For CPG, we will continue to collect information in your business plan on your inflation assumptions, specifically the impact on premiums and claims, and therefore price adequacy. We will also ask you how you are capturing inflation appropriately in your capital model within the capital focus area return, but this will be scaled back from last year. We employ a capital oversight model which is driven by year-round engagement. For 2024 capital setting, we will extend this further by moving a greater number of detailed capital reviews out of the time-critical CPG window where we have comfort to do so. This provides more opportunity for syndicates to address our concerns under less time pressure. One example of this is where we are moving away from the thematic testing of the mean loss ratio uplift syndicates use in their capital models. Instead, we will be relying more on our retrospective loss ratio test applied at mid-year, which monitors where loss ratio performance implies a systemic understatement of capital over a 5-year period. This doesn't mean that we won't intervene during the CPG period if something looks inappropriate or doesn't have sufficient validation supporting it, but we will place more focus on interventions driven by performance-based evidence. We continue to utilise our capital fast-track process for syndicates that meet our eligibility requirements, which are driven by your capital principal rating, as well as movements in exposure to risk metrics. I want to remind you that capital fast-track does not change the requirements of the capital submission. It also does not guarantee that Lloyds won't have queries or issues approving the capital submission if these are identified during the LITA review, but we will adopt a higher tolerance to not request further information and to defer queries to later in the year where appropriate. Our approach to capital reviews and loadings continues to be risk-based, and we ensure that any intervention matches our view of the materiality of the issue. For example, CPG has a practice of waiving loadings where they fall below a certain threshold and don't represent a systemic market-wide risk. Loadings that are applied are not a punishment. They are genuinely to compensate for what we believe is identification of a material undercapitalisation or the risk of that arising in the future. Likewise, indicative loadings are not intended to be a threat. We communicate indicative loadings to syndicates where we are signposting a concern of material undercapitalisation, and if we do not gain that further comfort, our action would be to propose a capital loading. This provides syndicates a final opportunity to tell us if we have missed or misunderstood the justification for your modelling. This is an important part of our process, but doesn't guarantee that we will agree with the reasoning provided. We are very much on board with making this process as smooth as can be, while of course achieving the main objective of adequately capitalised syndicates. We are consulting with actuaries in the market around how to improve the process and welcome feedback from all areas. The process is generally more risk-based than it has been, at least in the 4 years since I joined CPG, and we are firmly signed up to taking that further. I'll now hand back to Patrick.
Thanks, Emma. So just before we wrap up our prepared remarks, I just want to touch on claims for a minute or two. On June 1st, we announced changes to the Lloyds claims scheme, now known as the Claims Lead Arrangement. These changes represent a positive step forward for the Lloyds market and our claims offering. I'm pleased to see some progress, but if I'm honest, what was announced last week falls short of my longer-term ambition for claims management and customer experience in the Lloyds market. There is no justifiable reason, to my mind, that claims service should not be a key strength of the Lloyds brand and be a positive driver of higher retentions and lower ALA costs. There's much more work to be done in this space, but thankfully there's much work being done. We are excited about the progress and adoption of the faster claims payment solution with Vitesse, and we expect this to be the standard in the market very quickly. We see claims taking on a more prominent role within Rio alongside underwriting, culture, reserving and governance. And this will allow us to recognise and reward syndicates who have claims lead capability, who clear conflicts at the point of bind, who manage TPA and legal panels well, and who see claims service as a differentiating offering, and to have that be accretive when it comes to how you operate in Lloyd's time future. I'd like to thank the LMA and the LMA Claims Committee for their partnership in delivering the Claims Lead Arrangement, and do look forward to working closely on what I believe will be an area of broad-based alignment for the best in our market. Personally, I see it as an essential strategic ingredient in the future-proofing of our market. So to wrap up, key takeaways from today. We are operating in a period of continuous elevated risk, and ensuring the market is managing these risks appropriately gives us confidence to allow the better performing syndicates the flexibility to build their businesses at Lloyd's. The previous 2 years of underwriting profit gives us reasons to be optimistic, but not complacent. The planning and capital process for 2024 will see us increase differentiation and focus on material prudential risks. We expect to see continued growth in the market, and we're excited by some groundbreaking initiatives we see in development that could provide a step change in the development of our market. Now, in September, we will share our views with you on strategic growth areas for the market as our commercial strategy starts to bear fruit. Our goal is to create the frameworks and infrastructure to promote the attractiveness of the Lloyd's platform for you and your capital partners to execute your strategies here with appropriate diligence. Finally, I will close with 3 asks of you. First, what must we do in these current conditions to ensure a legacy is built and an opportunity is not squandered for the market? And what can Lloyd's do to help you achieve sustainable, profitable growth and increased relevance for your customers? And lastly, what elements of the market do we need to build or rebuild to ensure we pass on to the next generation a market that is equipped for the underwriting challenges of the future? So thank you again for your time, and now we'll pass over for questions.